Hey everyone, it is Thursday morning, which means the new unemployment claims came out. It also means we're following up with Greg Dickerson to have a talk. So how you doing, Greg?
I'm doing good. Michael, how about you?
Pretty good. You nailed it. I think you pointed 5 million exactly, and I'll
Yeah.
give it to you. It came in at 5.245. So can I have the lotto numbers and I'll split it with you?
Yeah. It just seemed like a logical number. I thought we'd be closer to 10 the week before. And
Okay.
I think, a lot of it was just people couldn't get through the system. And
Hmm.
I think there still are a number of people that can't get through the system, but seems like we're coming to that's starting to decline as well. So hopefully,
Yeah.
we'll probably see another five next week, I bet you.
Oh, okay. Well, let's put this on air. So you're calling 5 million next week as well.
I think so.
I'm going to call 3.
Three. Yeah.
Yeah, let's do 3.5. Let's do
Okay.
close,
Three and a
3.5.
half. Yeah.
Yeah.
I think we're going to see another five.
Okay. All right.
I think we're just getting the backlog that couldn't, like I said, they couldn't even get through.
Yeah, very true. And we're going to start to suffer second order derivative closings. Like I know
Mhm.
Silicon Valley is starting to lay off, right? We've been in the Bay, we've been on lockdown close to 6 weeks. And really all the tech companies are like just work from home, work from home, work from home. But it's getting to a point where they're getting into the corridor, realizing their pipelines turn to nothing. Companies aren't paying them. So I expect Silicon Valley layoffs to start here soon.
Yeah.
So you could be right.
Yeah. Yeah. Big retail. Another bad week like that. But it's crazy, man. Everybody's like in the real world except Wall Street.
Yeah,
You
no
know,
kidding.
all this bad earnings comes out, all the unemployment numbers come out. What happens? The futures in the market shoot up. It's like, what the
Yeah.
heck are these people thinking? But
Yeah.
so here's the thing. Okay, so if you notice the banks when they released earnings yesterday, they lost money everywhere except their trading desk.
Yes.
So what's happening is, like we talked about the other day, all this liquidity. The reason the market was at 30,000 before this happened was because it was all the liquidity that's been pumped into the Fed, that the Fed's been pumping into the banks, and they're using it to trade stocks.
Hmm.
So that was an easy bet, right? Everybody's shorting the market, so the banks go in and what do?
Yeah.
They go in there and put a bunch of puts in, and bam, or I don't even know what that's called, but they're betting on it going up, not down, right?
Yeah.
So,
Yeah.
um, you know,
It's crazy. Crazy. But something I thought I would do with you today, Greg, is
yeah,
kind of let's put out some, I don't know, I guess our opinions on, I don't know if I want to call them warnings, but maybe it's things that are just too hot for us to touch. And what
yeah,
I mean by hot is there's just too much pain. It's too early. And really what I want to put this out there for is I saw a lot of people in the '08 crash that were actually positioned okay, but they went all in too early and ended up getting hurt because that was a very long downdraft. And if you bought in at 20% discount, at least in
hmm,
my area, you still suffered another 40% drop. So
right.
it didn't feel good. So what do you think has too much pain, is going to be too much to unwind, and should not be looked at by the average investors? There's always the experts, the special folks, but just the average mom and pop investors. What is too hot? What should be avoided the next 12 to 18 months, you think?
Yeah. So obviously hospitality, and that's out of the average investor's reach anyways, other
Yeah.
than small like motor lodges or something like that. But that industry is going to be out of reach for a lot of people, and you just want to stay away from it because there's no telling how long that's going to take to come back. There's going to be some really great deals,
Mhm.
really good opportunities, but you got to have deep pockets, patient capital. So that's one. Retail, you definitely want to stay away from retail. And I've heard a lot of people saying there's going to be a lot of opportunities in retail, and you can buy some less expensive assets out there. So the average investor can buy some retail, but the problem is if the retail is vacant and it's selling for pennies on the dollar, there's going to be a reason. And what's the likelihood of getting somebody back in there? So
Mhm.
again, it can be a good opportunity, but you need deep pockets and you're going to need, patient capital to weather that storm. And if you're looking at those types of assets, you need to underwrite it, with the assumption that you're only going to generate probably half the income that you normally could to break even. So you have to
Mhm.
look at it from that standpoint. So I think those are the two most at-risk assets right now. So far, multifamilies perform well at all levels. Everybody I know, everybody I've
Mhm.
talked to are within 75 at the worst to 90% collection rate in all across the board,
Yeah.
ABC, properties. So I really thought like C and D properties would be the properties that would struggle and have an issue. But so far, that hasn't been an issue. So I would still keep an eye on those. I still think A and B is the place to be. Those are the ones that are going to do the best.
Mhm.
That's the workforce that's the most insulated and usually has the most reserves.
Mhm.
So the lower end multifamily properties I'd stay away from. And, right now, the real estate market is still good. Housing prices haven't really dropped in a lot of areas. I was on a panel last night with a bunch of builders, and several of them in your area in Northern California and Southern California, and they're still selling, over 2 million in Newport Beach,
Really?
in Orange County.
Wow.
Yeah, still a hot price point. He said if you get over 2.5 million, it slows down, but anything in the 2 million range is still doing well. And then somebody in, believe it or not, Austin, Texas, she's doing, $1.5 million spec houses and are selling. So,
Okay.
my market is still really good. I'm on the East Coast, near DC. So
Wow.
my whole region is doing extremely well. So anyways, retail, hospitality, those are the big no-nos right now. You don't want to go near them. And you want to watch your low income properties and just understand who the tenants are, what their employment situation is. And again, anything you're looking at in that area, I'd underwrite to a break even of 50%,
Yeah.
meaning your NOI needs to, or your occupancy needs to be 50% to break even, so you want to make sure that you can sustain that property at that level.
Yeah. That's interesting because it's interesting about Newport and Austin because I guess Texas is always like its own little world. So let's talk about Newport.
Yeah.
I wonder what the median price is in Newport Beach. Do you think it's probably like 1.2, 1.3, you think?
It's
Well,
up there. I mean,
I'm just guessing.
yeah, it's got to be over a million, close to 2, I would think.
Okay. So, because what I was trying to get at is it seems like 2 to 2.5 is a sweet spot. I'm just wondering
Mhm.
how far over the median that is because um, I guess where I was coming to this conversation is the stuff that I would avoid. And again,
Mhm.
I could be wrong, but I would avoid the high end. I
Mhm.
think the high end is in trouble. I think too much of that inventory was being built in most markets. There's always, maybe Newport's just such a constrained spot. There's no more land, right? That's always like New York. But yeah, I think I thought the high end
Well, you
would
got
be
to
in
remember,
trouble.
interest rates are still cheap. The
Yeah.
people at the higher end markets are still making money. They haven't felt a lot of this.
Yeah.
Especially the white collar jobs, Silicon Valley, San Francisco,
Yeah.
housing prices haven't dropped in San Francisco. I mean,
Yeah.
it's all, interest rates are still relatively low. Those buyers that are buying $2 million houses are qualifying anyway. So,
Yeah. Even the jumbo loan market though, I heard that's in trouble. Maybe they're paying cash. Maybe. I don't know.
a lot of them paying cash.
Wow.
You could get jumbo loans, but they're just a little bit more expensive, and
Yeah.
the criteria is a little bit more stringent. But yeah, some lenders have pulled out of that market.
Yeah. And then the other area that I was thinking about that would be I mean, again, I say this as an owner of a property in this market, but New York City. I think we just don't know what's going on in New York City now, whether
Yeah.
it's residential condos. It could be fine. It could be like 9/11 where they had a quarter bump, a quarter fall, and then it comes back. You know, I am not of that belief. I think New York City, right, Manhattan is in trouble.
Well, here's
And
the big thing. So if you're talking about geography, geographically where to be. So what I would look for is the states that have, like New York, California, that have serious rent controls, and they're going to get even more tenant friendly
yeah,
through this environment. So you may not even be able to raise rent at all on, in place residents, and then only so much going forward after this, situation for a while, because this ain't going away. Until you
yeah,
get a vaccine, this is not going away. So, the coronavirus economy and the housing market is going to exist for some time. So
hmm,
there's going to be a lot of, tenant friendly laws out there to protect people that are losing their jobs. Even after we go back to work, if somebody gets sick and loses their job, you're not going to be able to evict them. So this is going to be something you're going to have to deal with for a long time. So just be cognizant of that. I'd stay away from hotspots. I'd stay away from rent control areas, and I'd stay away from, anywhere where the weather is bad. So
hmm,
I'd stay in the Southeast United States where,
yeah,
the weather is nice, it's consistent. And, generally they're not having as many issues in those areas.
yeah. The other one that I would stay away from, it's in the hot spot, but it's in what would it be? The Southwest is Las Vegas.
Yeah.
I think Las Vegas it's going to have a hard couple of years. It's been overbuilt, very dependent on kind of that travel and leisure, all the services that are around the casinos. There's just not a lot of industry open in Vegas today. And I could only imagine what it's like being a landlord in Vegas today.
Yeah. Yeah. It's, that's an interesting market. And, it went from the best housing market to the worst housing market back to one of the top housing
Yeah, you're
markets.
right.
You know, so it's really interesting. I think the inventory levels are the key to watch there. Now, Arizona,
Inventory. Yeah.
Las Vegas, good environment, good climate. I don't think they're having big outbreaks, hotspot issues like some of the
Yeah.
other areas. those could be good areas for buying. You just got to watch them, what the renter laws are like there and things like that.
Hmm.
But, at the end of the day, I think right now it's too soon. Okay.
Yeah,
So
that's the point. Too soon. Yeah.
it's just too soon to know. And the market is still good. I mean, inventory's down, home builder, all those reports came out, permits are down, all that. So we've got a housing undersupply right now, believe it or not,
Yeah.
all
No,
across the country. We do
you're
not
right.
have enough housing out there. So as long as that stays steady, builders have not been able to keep up with demand, partially because of the labor market, partially because they're not building like they used to. So they're not going out and building thousands of homes
Mm.
and hoping people will come. They're building as they're sold. So it's keeping the inventory under control and at a pace where the market can absorb it versus 2008 and 9.
Mm.
The other thing is, this isn't as bad generally as 2008 and 9, but from an economic hit, it's way worse
Oh, way
all at
worse.
once because it all came at once.
Yep.
And it's going to take another year to 18 months to work back out of this, to get
Yes.
things firing because of what's going to happen once we do go back. Once they open the doors, we're going to have outbreaks. We're going to have, they're going to lock them back down again. You're going to have limited, openings of things and gatherings and stuff like that. So it's going to be a 12 to 18 month period. So if you look at 2009, March of 2009 was the bottom, where the real effects were felt were all through the end of that year. And it wasn't until 2010 and even 11 when it was time to jump back in and start getting after it.
Yeah, you're right. Yeah. And then the other thing that I'm nervous about that I think, again, it's too early to look at is markets that have been dominated by Airbnb that are more like vacation spots, right? A lot of transactions happened in the last couple of years because people justified, $99, $300, $400 daily rates that just aren't going to happen for a while. So I think there's going to be a lot of pain there, and it doesn't being early in an environment like that is not a good idea, I don't think.
Yeah. So my market where I came from was a vacation rental market, summer vacation destination, Outer Banks of North Carolina, where the Wright brothers took off in Kitty Hawk.
Cool.
They're shut down and have been since March 27th. They closed access to that beach. So you can't get, even if you own property, you cannot get there.
Oh, wow.
And out-of-state property owners. So, they closed it off to everybody but the year-round residents. And I have family there and I can't even go visit them,
Wow.
So, there's nothing happening there. So there's going to be a lot of, depending on how long this goes. So they've already lost April and May, which are, off-season rates, but it's still, a decent income. But if they lose any of May and June, and then once you get in July, those are peak weeks where some of these houses rent for $10,000 to $50,000 a week. It's kind of like the Hamptons, except for not as high end, but there's some big houses, 8, 12, 16, 24 bedroom houses that rent for a lot of money.
Wow.
So that's a market that I'm keeping an eye on that, a lot of those sellers aren't going to be able to survive this loss of income this year, and they're going to have to sell those properties.
Yeah. So let's play this out because this is something I'm actively looking at. So, so they have a residential loan, correct? Because it's a house. Even if it's a big house, it's residential. Okay.
Yeah, it's residential. Yeah.
All right. So right now, under the rules of most of the loans, they can get 90 days forbearance, no questions asked.
Right.
I hear talk now that they might be extended pretty easily to 12 months. So if we play that out, somebody who has a big ass house in the Outer Banks of North Carolina, they probably won't get into real financial pain having to make a decision until January, February of next year, right?
Yeah. So they'll take advantage of that because the initial forbearance, you just fill out a form and you're done. Now.
Done. Yep.
I don't know how that works for vacation homes. Okay. So these are investment properties. They're residential, but they're investment property loans.
That's true.
So banks are looking at that differently because they're saying, wait a minute, this is not your permanent house. This is investment loan. You submitted documentation that you had the amount of money you needed in reserves. So you need to pay your mortgage.
Yeah,
so
that's true.
My understanding from a lot of the lenders for those types of properties is that, it may not be as easy as just filling the form out on the internet, but let's say it is.
Yeah.
And they can get that initial 3 months, no documentation.
Yeah. I think everybody gets 90 days.
Okay.
Everybody.
So let's assume that's the case. So you get 90 days, but at the end of that 90 days, you got to pay it all up.
Exactly.
All time.
Yeah.
So that will get them through the summer season.
Yeah.
They'll probably break even. They're not going to make any money. So they'll probably put that house on the market that fall. So that fall and winter will be a big.
Okay. So September, October.
I don't ever want this to happen again because this is going to keep going.
Yep.
They're going to have this in the back of their head and say, I'm done. I'm out. I don't want this to happen again. The problem is a lot of those houses don't have a lot of equity, so you know, it'll be interesting to see how that goes. And what we saw back in 2008 and 9 was really interesting. People were collecting rental income, not paying the bank.
Yep.
So now whenever a property goes into default and a notice is filed of default, the rental company seizes all the income and doesn't release it to the owner. And then the other thing they do is they guard that house, because the owners were going in, clearing out all the furniture,
stripping them. Yeah.
selling them. So
I
you know,
remember.
so we were seeing those houses getting cleaned out left and right in 2009 and 10, and then all the short sale business started and all that.
Oh, yeah.
So anyways, it's too early there. We'll see, you know, fall, depending on how deep it goes into the season, what ends up happening. But I think we're going to see a lot of people put those houses on the market this fall and in the winter. But it's a very unmotivated seller market. It always has been, because their income generated. I mean, those things they're like thoroughbreds. They do some very nice gross rent ratios. You know, they're usually around 10 to 15%, meaning the rental income is 10 to 15 times the value of the house, you know, on a gross rent multiple. So if it's if it does $100,000 a year in rent, the house will sell for $1 million, you know, so that's kind of how that works in that market.
All right. So let's play that out with that example, right? Let's assume the income stays the same. The potential income stays the same. Do you see compression on that, given just the amount of inventory that may hit in the fall and winter? Or do you think it'll always, you know, if it goes down, it'll be like 10%, it'll be 900 grand. I mean, do you have any gut opinion on that?
You know, so even with the low interest rates and as good as the market's been, we have not seen prices. We've seen prices come down on the houses. So we've seen that gap widen in terms of what you can buy for your dollar.
Okay.
We haven't seen prices going up, if that's what you mean.
Right.
Yeah.
Yeah. But I'm wondering so let's just play it out. Let's just say in January, you could buy $1 million house that produced 100 grand, which is, I think, what you said.
Yeah.
Now let's fast forward to next January, right? Where we have all this inventory coming on in September. Nothing is selling because everybody's afraid. Do you think you see price reductions then? Still produces 100 grand, but you can buy it for 800, or what do you think happens?
Yeah. So that's what I'm saying. And you can see that now. You can see some houses that are producing 100,000 that you can buy for, you know, 700,000-800,000.
Oh, okay.
Yeah. So it just depends on the seller. So really there's, you know, a lot of those people have owned property for a long time there. A lot of them are newer owners, but if they have the income to carry it, they're not going to dump it. You know, that's what I mean by it's the most unmotivated seller's market I've ever experienced.
Okay.
And even in the crisis, you know, I was telling people and making offers on land, because I mostly built. I didn't buy houses, I build them and sell them. And I'd offer money on their lot. And I'm like, look, the market's going down. This was 2009, 10 timeframe. Yeah. And I was still buying and developing even after that. And people were like, oh, no, it'll be worth twice as much in 10 years. I'm like, no, it's going to be worth half as much in 10 years. And I was right. The values have gone down over the last 10 years, about 50% from where they were at their peak. And they have not come back up yet. So that market has just gotten back to where it was before the boom in 04 and 05. That was the peak of that market. They're back to 2000, 2001 levels. Okay. And everything ran up to 05, had a little dip, then it ran up to 09, and then it got cut slam. I mean, that market got cut slam in half by about 50% in terms of values.
Okay.
But the renters kept coming and the rental income kept increasing.
Right.
But what happened is post 2009, and especially the last 3 years, rental incomes have increased exponentially. Interest rates have dropped exponentially. So it's the perfect storm in terms of buying cash flow for those short-term rentals, for those properties. They become very attractive. And land costs have come down. So those things are thoroughbreds. I mean, I'm telling you, I can build a $2 million oceanfront there right now. My cost, land and house, $2 million that will rent for $250,000, $260,000 a year. And you can get 3.5% money on that. At one time. I don't know where it's at right this minute, but you could get 3.5% money 5 weeks ago.
The world has changed.
You know, so you put 20% down, you're going to get 60% of that income. I mean, that was a 12, 15% return.
Yeah. Very cool. The other thing I wanted to ask you about, given your history and experience, is what do you think about kind of, I don't know, new development of strip malls or single level office to configure buildings? Because again, I think there's going to be a lot of inventory that comes on that's going to be vacant. And do you want to be building that when you have all this kind of previously used inventory coming? What do you think about new development?
Retail.
Okay.
Yeah, not retail. Now, location specific, but in general, I think you're going to see a lot of vacancy everywhere. So it's going to be cheaper to buy than it is to build. Okay. For retail. So I wouldn't be messing with that right now, or office. I'd wait and see how that shakes out. Right. But multifamily, I'm great. I'm fine with multifamily. I think if you can, and the lending is still there for multifamily.
Sure.
you'd be lucky to get a loan right now for a new retail development for 50%
Oh,
LTV. So, or LTC. So,
I couldn't
that's the
imagine.
big thing that's changed there. But yeah, that's not a smart move right now, unless you are somewhere where there isn't anything and nobody's been affected. I don't know where that is, but
Yeah,
could be. So,
maybe.
you know, I'm going to say there are, market specific, but in general,
Yeah.
you got to wait and see how this shakes out, see what that retail landscape looks like before you break ground on something. But, again, I'm fine with multifamily, especially smaller niche projects, 20, 40, unit deals.
Okay.
I think those are really good because you can get them done quick and you can lease them up quick.
Yeah.
The 180 to 250 unit deals are going to take you a little bit longer to get done and get leased up.
All right. And then one of the things that obviously drives this going forward is going to be what's lending like in a year, meaning bank lending. I think we're in an environment that's unquestionably bank lending is tightening, right? You
Mm-hmm.
saw all the big banks have huge reserves for bad debt here recently.
Yeah.
I think bank lending certainly gets tighter the next 90 days. But do you think if you fast forward a year, do you think, I guess this question, assuming today's the baseline, do
Yeah.
you think lending is easier or harder in January?
All things considered, we get a vaccine, everything's coming back to work, people are paying their rent, and we're not seeing defaults.
Hmm.
I think it gets easier and it loosens up again.
Okay.
Look at what happened post 2009 to now.
Okay.
We are back basically before this happened, where you could almost get no
Yeah.
documentation loans again.
We're almost there.
Yeah.
Yeah.
So, those guidelines have loosened up quite a bit, and everybody knows that is the key to our economy. It's all about the liquidity.
Yeah.
It's all about the lending in the mortgage market. That's where the Fed and the Treasury meet Main Street. That's the only place they meet it. This SBA stuff and paycheck protection stuff, that's not helping anybody. And it's not going to help anybody. It can actually do damage. So where it's really the rubber's going to meet the road with the mortgage market, keeping rates low, keeping that lending pipeline open for people to be able to take equity lines out, buy houses. That's what's going to keep this economy going. The other stuff, it's just a burden on a business to have that debt behind them when they get back open, because,
Right.
they're dealing with a bank. That's at the end of the day, it's a bank that's loaning you that money, and it's up to them verify all the documentation, income, and all that. So, for businesses that can survive, depending on, if we're 2 to 4 weeks away from getting, somewhat back to business, the problem is they're not even going to be at break-even numbers in those businesses for another 6 to 12 months.
Yeah, no kidding. Yep, long time to think about. It's fun to think about though, right? What's going to be exciting? What's too hard to touch? Any kind of closing thoughts as you look at the business environment into this year, beginning of next year?
Yeah, it's going to change. It's going to be different. We're going to see the face of industry, retail, food service, hospitality change dramatically, right? So there's going to be a lot of iconic brands and companies that are no longer going to be around, which has been happening anyways. There's going to be more labor. So everybody was hurting for help. Yeah. So I don't think jobs are going to be a problem. I think, the restaurants, hotels, and retailers that can reopen are going to rehire all those people. The problem is they're getting paid so much stinking money. There's not a lot of motivation for some people to go back to work.
Amen.
In some states you can make more on unemployment than you were making before you got it. So that's a problem. But at the end of the day, that's money that they'll be spending. So I don't think we're going to have a problem getting people back to work. That'll open up, opportunities for employers that were struggling to get help before, because everybody was stressed trying to find help, especially in the food service industry, hospitality industry. They just struggled. The big issue is going to be, the conference business, sporting events, colleges. I don't know what that's going to look like, those types of things. But it's going to be different. It's going to change. I feel good about the lending market. I think the government stepped in at the right time quickly and shored all that up. So I think that'll, and even Freddie and Fannie say, hey, this is temporary, give it 6 months. Let's make sure everybody's performing. They're advising their smart operators to, suspend distributions, build your reserves. Let's get through the next 90 days and then revisit that. So I think the smart operators are building their reserves. They're not, paying the distributions. They're not making big capital expenditures. They're keeping cash, because you got to protect the asset. You got to protect the investors, right? And that's how you do that. So, that's what's coming down from Freddie and Fannie, and they're saying, give us 6 months, and then, they'll probably open the floodgates again.
Yeah, I agree. Well, this is always fun. I always like talking to you. It helps me understand, get clarity on all the stuff I don't know, frankly. So I always like learning from you, Greg. I appreciate you.
Yeah, it's a lot of fun, Michael. I enjoy it.
All right, buddy. Take care of yourself. Thank you.
Yeah.